Well, hello folks, this is T. Brian Hayes here from Hayes Advisor Group with your August 2015 Educational Economic Update, where we recap some of the most important economic events from last month and give you some insight into what they might mean for you as an investor. Please stay tuned at the end for a required disclosure statement. Now, as you are aware, August was a rough month for global financial markets. A Greek debt crisis, worries about a Chinese recession, and uncertainty around a Federal Reserve interest rate hike all took their toll on investor sentiment. All of these factors and more caused the markets to take a pretty big hit in August. Now, I can go into detail on each one of these factors, but I don't think that I need to. Most people simply do not care about what factors affected the market and caused it to go down. They only care about why it happened and what is being done about it. So for this month's update, I'm going to focus strictly on the markets and your accounts and explain to you what is going on and what is being done about it. The fact is, the markets have finally gotten volatile and erratic after being on a historic, long, very low volatile bull run. The markets were way overdue for a correction, as most people realize. However, even with that said and understood, it is still hard to go through once it is finally here and happening. As we explained several times in the past to you, if you have money in the market, you're going to experience some up and downs at times. There's no money manager in the world that can prevent short-term losses at all times. That's going to happen. Remember, professional money management is a process. You have to make adjustments based on different market cycles and conditions to keep the portfolio in a low volatile, high relative strength position at all times. That does not mean that the portfolio is not going to lose money at times. It will through transition periods. There's no way in the world to prevent that. But what it can do, again, is prevent the big hit and keep the portfolio in a low volatile, high relative strength position at all times. That is professional money management. Remember, the key to growing money and achieving compound interest over time is to limit the downturns to acceptable levels between 1 to 10% or so and to avoid the steep declines. If you can do that, then you will achieve compounding interest and growth over time. The fact of the matter is that this, right now, is just one of those minor corrections. We are still in the range of the normal 1 to 10% or so, and this is not going to affect you over the long term if you continue the course with your professional money managers who have been and are making the proper moves based on this new market environment. The bottom line is that the market conditions have changed finally, and volatility has picked up sharply as we've been communicating this to you through emails, newsletters, phone calls, emails, etc. But remember, we do not go from a bull market to a bear market overnight. This is a process. It takes time to figure out what the overall market's going to do. Let me explain with some data and some charts. As of market close last Tuesday, the SPDR S&P 500 ETF is down 5.7 year to date. From peak to trough, though, it sits in a 9.73% drawdown. Perhaps worst of all, 7 of the last 9 trading days have seen returns in excess of 1% in magnitude. Minus 2.05%, minus 3.12%, minus 4.08%, minus 1.22, plus 3.79, minus 2.84, all of these very erratic days. All that volatility is going to give anybody some heartburn. So, but that being said, it should not be enough for us to want to be fully defensive. To sell everything and go entirely to cash, well, that's a key question. So should we do that? Well, let's find out by comparing this to the very similar environments of 2008 and 2011. Let's take a look at our first chart. As you will see here, we align the peaks of 2008, 2011, and 2015 with the return of $1 after 30 trading days. Now let me ask you, can you tell me which is 2008, which is 2011, and 2015? It's very hard to tell, isn't it? Well, let's take a look a little bit further down the line. Let me change my chart here. Now let's consider the first 160 trading days, which is about 7 months. Now, can you tell which of these returns is 2011 and 2008? Again, it looks very similar, doesn't it? Now, from this point on, 2011 went on to grow 18%, but 2008 went on to sell off another 50%. But they're nearly indistinguishable over the first 160 trading days. Now, let's put it all together. Let's take a look at the full picture. So this compares all 3 years together, 2008, 2011, and 2015. So as you can see, you can't really tell a difference at all right now between these 3 cycles. It's very difficult to tell a difference. You know, the global financial crisis unfolded over 355 trading days, or about 1.4 years, and 2008 isn't the exception. You know, our research shows us that most large drawdowns in equity markets tend to occur over months and years, not weeks. Now, while we believe in tactical risk management, we do not believe in tactical for tactical's sake. This means recognizing that while jumping immediately out of the market may feel good when the markets get turbulent, this is precisely the type of emotional response that we're trying to avoid. While waiting for confirmation of the market's direction can be stressful, it ensures that we don't position the portfolio for 2008 when it's really 2011. That's where whipsaws come into play that can really devastate a portfolio. Bottom line is that it's anyone's guess as to where we head from here. So you cannot make uninformed, irrational decisions right now. That is just a guessing game and why so many people get hurt in the market. It takes tremendous knowledge and expertise to protect a portfolio and to avoid whipsaws during these transitional market times. Honestly, it is the most difficult time for you as the investor and for the money managers themselves. But this is the time where we earn our stripes and our living. You are relying on us. Let us prove our net worth to you. So please don't make irrational decisions during times like this. Again, trust your money managers. They are the best of the best. They know what they are doing, and rest assured they're making the proper moves as we speak. So I really do hope that explanation and charts helped you kind of understand what's going on now. And rest assured everything is fine and accounts are being managed properly. Now, on to a lighter topic. We are preparing for our fall education drive. Coming up soon, we're going to be doing some Social Security educational classes. These are designed for people ages 55 and over who have not turned Social Security on yet. I'm also going to be doing a retirement estate planning college course. You know, this course is designed to get into full depth on all areas of retirement and estate planning, like tax planning, income planning, long-term care planning, investment planning, inheritance planning, asset protection, you know, everything. So if you'd like to attend either one of these classes or courses, you know, please call our office to reserve your spot. There's absolutely no cost to attend for clients. As always, if you have any questions for me, feel free to reach out to me at any time. I truly value our relationship and have your best interest at heart at all times, and I'm going to continue to work extremely hard to make sure your money grows and is protected the best way and for your overall retirement nest egg at all times. So I look forward to talking to you and speaking with you soon. Have a good rest of your day.